Hey y'all, Jen Hernandez, Loan with Jen. What is a second lien loan? We will be right back. Okay, we're back. Second lien loan. There's a couple of synonymous terms that you might hear out there floating. This is regarding when you're buying a mortgage and there's a second lien loan. It's also called subordinate financing, which means it's subordinate or secondary to that first mortgage loan. So some common terms that you might hear as you're researching or talking to friends is an 80-10 or an 80-15 or an 85. That means the first loan is 80% and the second loan is 15%. Now the total of that is 95%. Where does the other 5% comes from? That would be your down payment, okay? So again, the combinations of the loans don't have to be exact. Sometimes we've done a 73-22 or, you know, the cumulative amount between the two loans has to add up to however we're approving them. Sometimes the two loans add up to 80%, sometimes 95, sometimes at 90. So there's different reasons to do secondary financing. The main reason someone would do that is to avoid private mortgage insurance. Now, rewinding, on a conventional loan, private mortgage insurance, you could also watch my video on what is private mortgage insurance. Private mortgage insurance is PMI, and it is required when you put less than 20% down. So there are some people that don't want to pay private mortgage insurance. So they say, I want to split the loans up into two. So the first loan would be an 80 and the second loan would be, let's say, a 15 for a total of 95%. Okay, that can happen. Another reason, and by the way, in that one, the PMI would not be there because that first lender only has 80% exposure. So they don't care about the 15% lender. The 15% lender's taking all the risk. They're like, yep, no PMI. Now, the second reason that someone might do subordinate financing or a second lien, remember we're talking about what is a second lien loan, is they want to get that first loan below a conforming loan amount. So depending on your county and where you are in the country, most areas in kind of middle America and in Texas where I live is $510,400 at the making of this video in 2020. So the conforming loan limit is $510,400,000. That being said, sometimes we want to take a larger loan, like a $700,000 loan, and do a first loan that's below that 510 limit, and then a second lien or subordinate loan that will make up the difference up to their 10% or 20% down payment. That would be the amount of the second lien loan. Okay, that's another reason to do it. Why would anyone want to do a conforming loan versus a higher jumbo loan? Underwriting guidelines are tougher. The higher you go, lending guidelines and underwriting guidelines change, and it's harder to qualify for those jumbo loans. So that's a big reason why people might want to do that. A third reason is that people want to split the loan because later they might be selling a home and they want to pay off that second lien. They want to pay off whether it's a $50,000 second lien loan or a $200,000 second lien loan. They're like, hey, I'm going to sell my house, I want to pay it down, and I want to just be left with that first loan that's in place. So that's kind of another common reason. So those are the three main reasons that we see that. Now, a couple of things to side note if you're considering second lien financing. We're talking about what is a second lien loan. Something for you to consider and be aware and cognizant of is that the rates are higher. So on a first lien loan, the lender knows that you're trying to avoid PMI. They just know it because they know that the second lien is going to exist. So there is a risk factor added for that. So your interest rate will be a little bit higher, anywhere from 1/8% to 0.5%. Depends on your credit score, depends on your final loan to value, depends on several of those factors. So that being said, expect that it will be a little bit higher. Number two, the second lien loan that we're financing, that loan is higher as well. Again, it depends on the lender, depends on the state where you live. In Texas, those rates right now are in the 5s, 5.2-ish. If you're putting just 5% down, then those rates are even higher, into the 6s. So you just need to, with your local lender, evaluate the blended rate and how that might compare to what your other options are. Again, sometimes the split loan option is the very best way, and sometimes it's not. So it's important to talk to your local lender about that. I hope that you've gotten a lot of good detail and talking points from what is a second lien loan. Talk to you soon. Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.